Hi traders, welcome back to Trade KJD, where we simplify trading concepts to help you elevate your skills. Today we're diving into a topic that's been gaining a lot of attention lately: fair value gaps. What they are, how they form, and how you can use them to improve your trading game. Stick around because by the end of this video you'll understand how to spot these gaps and leverage them to make smarter trades. Let's start with the basics. What exactly are fair value gaps, or FVGs? In simple terms, a fair value gap refers to a price imbalance on a chart, often created during periods of high volatility. It's when price moves so quickly that certain levels aren't traded as much, leaving an area of inefficiency in the market. Fair value gaps typically occur in 3 consecutive candles. Here's how it works. Number 1, a large impulsive move creates an imbalance. And number 2, the second candle doesn't fully overlap the wick of the first candle. And last but not least, this leaves a visible gap or inefficiency between the 2 candles. This gap often acts as a magnet for price later because the market loves to rebalance itself over time. So why should you care about fair value gaps? Great question. Fair value gaps can provide insights into potential future price action. Markets seek efficiency, and these gaps often signal areas where price is likely to revisit before continuing its trend. We'll go through some bullet points now. Number 1, we have gaps highlight areas of imbalance in the market. Number 2, we have they often align with institutional trading strategies. And last but not least, gaps can act as support or resistance levels when revisited. Essentially, fair value gaps give us clues about where big players like institutions or hedge funds may have entered or exited trades. And as retail traders, we can use these zones to plan our own entries or exits. By now you might be wondering, why should I bother using fair value gaps? Here are some key benefits of fair value gaps. And number 1, we have precision entries. FVGs give you a clear zone to focus on, reducing guesswork. At number 2, we have better risk to reward ratio. Since FVGs act as magnets for price, your trades often have a high probability of success. And number 3, we have works across markets. You can use FVGs in Forex, stocks, crypto, and even commodities. And last but not least, we have aligns with institutional trading. Many institutional trading strategies revolve around exploiting inefficiencies like FVGs. Fair value gaps are a powerful tool, but like any strategy, they're most effective when combined with solid risk management and a clear trading plan. If you found this video helpful, make sure to hit the like button and subscribe for more trading insights. And don't forget to drop a comment below. How do you use fair value gaps in your trading? What's your experience been like? Thanks for watching, and as always, happy trading. See you in the next video.